So, post-election results on 4th of June 2024, when it was clear that the coalition government was formed, there were a lot of hints that the upcoming budget on 23rd July 2024 will have a populist measures and government capex might slow down, and a lot of ifs and buts on capital gains tax rationalization and changes in the tax slabs as well. So to go get more insights on the impact of the budget, we are privileged to have Mr. Pramod Achuthan, partner EY, and Mr. Neeraj Menon, another partner at EY, as our esteemed guest speakers. We look forward to this enlightening session. Now, let me introduce Pramod Achuthan. Pramod has been a merit ranker in both his chartered accountancy and company secretary exams. Congratulations, Pramod. Pramod has a 23 plus years of experience in corporate tax, international tax, and individual tax matters relating to multinational and domestic clients across a wide range of industries. He has worked on international acquisitions, investments, structuring assignments, and cross border transactions. He has also worked on restructuring assignments, including mergers and demergers, keeping in mind future business and promoter objectives and tax optimization. Welcome, Pramod.
Thank you.
Now, let me introduce Neeraj Menon. Neeraj has 22 years of professional experience in manufacturing, real estate, multi-state VAT, and renewable sectors, etc. Actively supporting clients with green initiatives and related incentives and compliance. He has assisted various clients for implementation of GST in India and played a vital role by assisting ENY Saudi Arabia in implementing VAT for its clients. Working closely with companies to assist them in advisory litigations under indirect taxes, including GST, customs, and foreign trade policies. Welcome, Neeraj. Would like to inform all the participants to be on mute mode. We will have Q&A session after the presentation. So request all of you to put your questions in the chat box. Welcome once again, Pramod and Neeraj. And over to you, Pramod.
Thanks, Pushkar, and yeah, good morning to everybody. It's a pleasure to be talking to everybody, and I think everybody who's taken out time on a Saturday morning, they seriously want to know more about the budget. So we hope your investment pays good returns. So happy to start off, and if you have questions as I go along, you can as well put it in the chat box. We'll keep 10-15 minutes at the end for Q&A, but you can keep putting questions in the chat box. Normally when the budget comes, what I do is I look at the newspaper headlines on the second day to get a sense of what is the feeling and what is the sense that everybody has. The Economic Times headline, it said a podium finish for jobs and taxes. Podium finish, we have the Paris Olympic Games starting, and jobs, of course, jobs is a very big theme. In the FM mentioned jobs as a word 35 times in a speech, and there is a lot of good initiatives around jobs. And taxes, of course, we'll get into a lot of details, lot of changes. Simplification, rationalization is the theme, but there are instances where it has come to hit us as well, and we'll get into details on that. The Business Standard heading said political but prudent, and it, of course, you had Swaminathan Iyer who said that this is a government bachao budget, and there was a lot of talk about the fact that Andhra Pradesh and Bihar got about 25 minutes of time in the total 1.5 hours that the FM covered. And Mint's heading said growth at work. So these are the different themes, and interestingly, some interesting records that the FM set while doing this speech. This is the first time that a FM has presented the seventh consecutive budget. This is the first time in the history of India. The total number of budgets presented, that record is at 10, held by late Mr. Morarji Desai. But there's an interesting record that our current FM has. She also has the record, Indian record, for the longest budget speech, not this one, That happened in 2020, where it went on for 2.5 hours. But yeah, enough about records. Let's dive into the budget. And if we, the way we are constructing this today is, we'll cover some bit about economy numbers, fiscal deficits, and all of that. We'll focus on that to begin with. I'll touch upon a few policy announcements. I will then jump into some of the key direct tax proposals, and we'll focus on more of proposals which impact investors, individuals, more from a wealth advisory perspective. We'll not cover all changes, but we'll focus it in that fashion. And finally, my colleague Neeraj will touch upon indirect tax proposals. He will focus it more in a sectoral theme, telling you what all are the key indirect tax changes from for various sectors. Now diving into economy, Indian economy is in a bright spot. This particular graph shows you on the left hand side, what is it that different people are saying. Economic survey pegged Indian growth at about real growth at 6.5 to 7% for this year. RBI 7.2, IMF, ADP. So all of them, are generally saying, India's growth should be around in the 7% range. The budget itself talks of a 10.5% nominal GDP growth. So if you kind of remove inflation out of 10.5, the inflation should be in the range of 3.5 to 4%. That gives you the real GDP growth of 6.5 to 7. On the right hand side, if you see the middle column, that's the one that's really reflective of numbers for the current year. And India, of course, is a shining bright spot in that. This is real GDP growth across various countries. The overall world economy, it's likely to grow at about 3.2%. So there's a slight degrowth from last year insofar as the entire world is concerned. But India is really doing phenomenally well, and those are pretty encouraging numbers. If I move forward to the next slide, there, we've also now mapped over here, how has the growth been across the last 10 years or so. And you see that graph dip in FY21. That's really the impact of COVID, and then it shot back. And overall, like we said, India is doing very well. 10.5% growth, which is predicted for the next year. On the right hand side, there's a lot of, it's very heavy on numbers. But the key messages there is that the consumption expenditure, both private and government consumption expenditure, the expenditure is 4% and 2.5%. This is really the last column on the right hand side upper table. So consumption is not kicking off, and that is where a lot of initiatives are probably to spur investment consumption going forward. The capital expenditure, which is the third row on the in the box over there, 9%, that's doing pretty well. So government has been focusing a lot on infra spend. 11 lakh crore projected to be the infra spend for this year. So that piece is going on pretty well. In the table below, it shows you different sectors. What has the growth been? And while overall we said, the overall real GDP growth last year was 8.2%. Agriculture is the one sector which grew at 1.4%. That's the only sector which is lagging behind as of last year. This year, the monsoons seem pretty good. Pune, of course, we've had some good rains last few days. So 1.4%, we believe, it should go to about 3.5, 4% in FY25. So we'll see how that plays out, but it looks positive for now. If I go on to the next slide, which is really on the how the taxes kind of play up. You have the first column, which is the direct taxes. The second column, the growth in indirect taxes is shown. So overall, while the growth in the economy next year is 10.5%, the growth in taxes is 10.8%. So it's pretty much similar to the growth in the economy. And again, within that, direct tax is growing at 12.9 versus indirect taxes budgeted to grow at 8.2%. So what the government is saying is that the buoyancy in the direct tax growth is on the higher side. It's 1.22, whereas the buoyancy in indirect taxes is lower. It's at 0.78. So for every 100 rupee increase in the GDP, only 78 is the increase in indirect taxes. That's how you calculate buoyancy. Even last year, if you see, direct taxes is the one which has been doing pretty well. The buoyancy was 1.86. So really about 18% growth in direct taxes compared to 8.2% growth in indirect taxes. So taxes, we are doing pretty well. The economy is in a good space, and that really takes us to the next slide. If I can talk of, what is, total taxes. This is the tax to GDP ratio, which is shown here. And, we are for the next year, our tax to GDP ratio is about 11.8% at a center level, out of which 6.8 is direct tax and 5 is indirect tax. So indirect tax, you have you have GST, you have customs, that is indirect tax, and on the direct tax you have personal tax and corporation tax. Those are the two elements of direct tax. So overall 11.8, and what the central government keeps out of that is 7.9, and the balance 4 is kind of given to states. So that's how you look at the overall tax numbers. And another interesting statistic for FY24, the total tax that India is collecting, both at a center and a state level. At state level you have things like petrol and a lot of other taxes that get collected at a state level. So if you look at the total taxes, we are at about 18.5% of GDP. That's the total tax that is getting collected. And we think that number should more or less continue for the next year as well. We will not put it out there. We'll see how that plays out. The Going on to the next slide, if we can move, yeah, this is on the expenditure side. And here, we've just said, what are the different components of expenditure. So out of the total spend that the government is doing, 77% is revenue, 23% is capital. So those are the two broad numbers. Again, if you look at a theme and a trend, from FY23 to 25, the revenue expenditure has been going down from 82.5 to 77, which is, a good trend. And the capital expenditure has been going up. So, at 23%, out of which on non-defense 15.5%, that's a big positive. So this government has been focusing a lot on infrastructure, and that is borne out of numbers. And again, subsidies, if you see that third last row, 7.9% is the total spend on subsidy. So even that has been going down. Basically, the main components of this subsidy again is fertilizer and food. These are the two major components. The fuel subsidy has become a very small portion of this, and with the way the fuel prices have played out, I would think, it makes sense that, all of this is going down. So this is good to see that the total spend on subsidies is also under a good amount of control. I do find the education spend here a little odd, that, it's 1.2, while there are a lot of, from 1.8% of total expenditure on education, we are spending only 1.2. Again, on defense, 6.7 to 5.9. These are important sectors where, spend probably at least on education should be going up. So, it going down is not a great sign. But there are some interesting initiatives on the job side, and we'll touch upon that. So, having looked at the collection side, the receipt side, and the expense side, we'll now dive to fiscal deficit on the next slide. So here, if you look at it, the numbers that are predicted for FY25, the number predicted is 4.9%, which is very, very big positive. So really fiscal discipline has been maintained. In the interim budget, the FM had said will target a 5.1%. So another 0.2% basis point, she's brought it down. So 4.9 is a big positive. And the government, of course, had this bonanza of RBI dividend of about 2.3 lakh crore. And that 2.3 lakh crore represents about 0.4% of the GDP. And out of that 0.4, 0.2 has been used to reduce this fiscal deficit. And the balance has been used for revenue expenditure. On the right hand side, if you look at it, the first column on the RD by FD ratio, this is really the revenue deficit by fiscal deficit ratio. And what it is showing is that about, from 71% in FY15, we are down at about 36%. So, the revenue spent out of fiscal deficit is only 36%. And fiscal deficit is largely being used for capex, so that again is a positive sign. And the debt ratio, center and combined, the center's debt ratio is 55% of GDP. And if you add debt of states, then it goes to about 82.5%. So this number also, from an FY21 number of 88.4, it has gone down to 82.5. So I would look at it as a big positive. We've shown a trend of, the deficit going from 4.9 to 3. Now, this is not mentioned anywhere in the speech. This is just a predicted number. If, we have a 0.6% reduction or 0.7% reduction in deficit every year. What the FM said in the speech is that, once we reach 4.5, we're not going to focus so much on fiscal deficit. We are on the other hand, going to focus on the debt ratio. We'll try and bring down debt ratios, and at least from the way sovereign ratings take place, we believe that's a good way to look at it, and it should have a positive impact on sovereign ratings going forward. So that's really the part on numbers, and I'll now move forward to the direct tax part and the policy part. So coming first to the policy part, some very interesting policy announcements. We've captured only a few over here. But first is this whole focus on jobs. We mentioned that the word jobs is mentioned multiple times in FM's speech. She has come out with a scheme to encourage, new employees. So scheme A, which is applicable to all sectors, it is saying that for the person joining job for the first time, they will give a subsidy of 15,000 up to a amount of 15,000. And the salary of these individuals should not be in excess of 1 lakh rupees a month. So 15,000 rupees is a subsidy that the government will give in 3 installments. The second installment to be paid subject to the individual completing a program on financial literacy. So interesting program where money gets paid directly to the new employee, on getting a job. The second scheme is only for manufacturing. The first one was for all sectors. The second scheme is for only manufacturing sector, where they are saying that first time hires, we will give a percentage of the PF contribution back. And there is a amount of about 24% for 2 years, 16% for 1 year, and 8% for 3 years, with a salary cap of 25,000 for doing these calculations. And they have said that companies should increase the total number of employees. They should hire more employees, and if they satisfy certain percentages, we will give more money back. We will fund the PF contribution virtually. That's what they are saying. Scheme C, which is applicable to all employers, not just manufacturing, but all employers. This again focuses on increasing the number of employees, and there again, up to 3,000 of provident fund contribution, the government will reimburse for a period of 2 years, which is almost 72,000 rupees. A big positive again. And the government did say that if the employee leaves in 1 year, we will take back this money from the employer. But I think this is a very positive, scheme for spurring employment in the country. There's also a scheme on internships where the government has said for the top 500 companies in the country, we will have interns placed over there, and about 4,000 interns per company. And these interns, the government will fund about 5,000 rupees of internship fee per month, and the company is expected to chip in another 1,000 rupees, and that 1,000 rupees can come in from its CSR spend. So it's virtually free internship, and a big positive, I would say, to again encourage internship. We already have the Apprenticeship Act. This will add as another boost for interns in the country. I think from an ease of doing business perspective, for voluntary closure of LLPs, there is a scheme which is proposed to be extended. The National Company Law Tribunal benches, more benches being set up, especially for IBC cases. The foreign direct investment, overseas investment regulations, the government has said we plan to simplify this and facilitate more foreign investments, and also use rupee as a measure, as a currency for overseas investment. So some interesting schemes there, which we need to see the fine print. Nothing has come out in detail yet on this. We'll wait for that. Similarly, for ease of doing business, the government proposes to introduce a Jan Vishwas bill. So we'll see all of this. On the right hand side, on the direct tax side, the government has said this current income tax act is very complicated, very bulky. So we want to make it easy, lucid, and simplify it. So we are going to do a review, and within 6 months, we'll come up with a new act, which will have a lot of changes. So, we need to see how that works out. I may be out of a job in 6 months if it becomes too easy, but we'll see how that goes. I think there's also some changes on the indirect tax side where, the custom duty structure also, the FM said will do a comprehensive review. I think on the NPS side, there's a plan for minors that has been introduced, NPS Vatsalya. So, that again, will be something that we don't have any details, but it's a policy announcement which is there. I think this is the policy slide, and now I'll dive into the changes on the direct tax and income tax side. So a lot of changes, and I'll come to first from an individual perspective. What are the key changes? So the changes, the thrust of changes are all benefiting people who have opted for the new tax regime. That's point number one. So, none of these benefits, and I'll touch upon what are these benefits. None of these are for people who are under the old regime. They are all for people who are under the new tax regime. The FM mentioned in a speech that about two-thirds of the individuals in the country last year filed returns under the new regime. So she expects that this will benefit most of the people. So one is a small change in the slab rates. If you see, the 3 lakh to 6 lakhs has been made 3 lakh to 7 lakh, and some minor changes, and those minor changes should give about 10,000 rupee of saving, I would say. The next is standard deduction of 50,000 today that has been proposed to be increased to 75,000 for salaried individuals. So 75,000 only for people who are opting for the new regime again. And the last is this employer's pension deduction. There's a deduction which is available of up to 10% of the salary today. Virtually that 10% of the salary is a tax-free benefit that individuals get. The 10% is now proposed to be going up to 14% from this year onwards. So again, only for people who have opted for the new regime. So it's a positive step for people who have opted for the new regime. So these are the changes on the salary side. And overall, the FM mentioned a number of 17,500. That standard deduction, 25,000 into 30% is 7,500. And the slab rate benefit is about 10,000. So 17,500 benefit for the first two boxes. And for this pension, you need to add that as a further benefit. So that's the benefit that, she mentioned in her speech. And, going, onto the next slide, if you look at it, how does one decide whether to go for the new regime or old regime? There are a lot of exemptions, concessions which are not available in the new regime, but new regime has better slab rates. So the magic number that we talk of for people with a salary of 16 lakhs and above, the magic number is if your exemptions, deductions that are available only in the old regime, if that does not exceed 4.34 lakhs, then this new regime will benefit going forward. Earlier, this magic number was 3.75 lakhs for this level earlier. Now it has gone up to 4.34. And again, we've not factored the 4% pension benefit that is additionally available into this number. But 4.34, if your exemptions and deductions are not crossing 4.34 lakhs, then you should clearly look at the new regime going forward. So that's really on the salary piece. If I move forward, then and now this is the complicated one and one which will be of most interest. There are a lot of changes on capital gains. Fundamentally, you look at holding period first, before, which is the first three columns which are there on this chart. So the fund, what the FM said is we want to simplify the capital gains regime. It's very complicated, multiple periods. So fundamentally, she said for long term versus short term, we want to just keep two periods, 12 months and 24 months. And basically listed instruments, she said, for all listed instruments, we'll have a 12-month criteria. So, you will see 12 months as the proposed criteria in a lot of those shares, bonds, debentures, zero coupon bonds, all of that, she said for listed instruments, we will go with 12 months as the criteria. And for other instruments, she said, the 36 months that used to be there, we are bringing it down to 24 months. So converging it into just two basic rates which are there, two basic periods of holding to decide whether something, is long-term or short-term. From a slab rate perspective, again, you had a 15% rate applicable for listed equity shares, equity-oriented mutual fund units, and equity-oriented ETFs. So there was a 15% rate which used to be there. That is proposed to go up to 20%, and this applies immediately from 23rd July itself. So it's a change which is effective immediately. So they've gone and increased the short-term rate, the beneficial rate of 15, which was available for certain specified instruments, that has gone up to 20%. And on the long-term side, again, the 10% rate, you used to have a 10% rate and you used to have a exemption of up to 1 lakh. The 1 lakh exemption has gone up to 1 lakh 25,000 and the 10% rate has gone up to 12.5%. So, from a market's perspective, this is a negative that, the rates have gone up. But, somewhere the FM said, we wanted to rationalize and converge a lot of rates. And that is why we've done this. So that's really, on the listed equity shares. If you look at a lot of other instruments, the listed bonds under Section 50AA, ETFs, there you had, the short-term capital gains rate is what is typically applicable, and that's applicable at the applicable slab rate. And, long-term capital gains, is that applicable, not applicable? There's a lot of controversy around it. But if it is applicable, then, the rates now converge to 12.5 going forward. If I go to the next slide, which kind of talks about this complicated section 50AA. So 50AA covers, certain market-linked debentures and some specified mutual funds. And this change came in from 1st April 23. So, you have mutual fund units prior to 1st April 23, which, for which indexation continued. That indexation is gone away now. So that's another big change in the capital gains regime, where she said, while I'm bringing down the rates to 12.5%, for all assets, I am removing indexation as a concept. But, this section 50AA, it says that, it somewhere says that, you will not look at the period of holding. You will treat everything as short-term capital gains, and short-term capital gains are typically taxed at the applicable slab rate. And now, we have also put in there a column on long-term capital gains rate. Under 50AA, you should not have long-term capital gains rate, looking at how the language of the section is. But there is a fine interpretation there which says that even if it is short-term capital gains, the rate of tax applicable to long-term of 12.5 under the new regime or 20%, that could be explored in certain circumstances. It's going to be very litigative, but that rate is available. So the normal answer would be to say that all of this is short-term capital gains, that has not changed. It will be taxed at the applicable slab rate. That's the conservative position to be taken. And if I go on to the next slide on this specified mutual funds, this is section 50AA, that is now proposed to be amended to add unlisted bonds and debentures also. So unlisted bonds and debentures also come into the list of assets where all capital gains will be treated as short-term forever. And then you have this one more change. We've said that this change is from April 26. So April 26 is assessment year 26-27. So this is the only change which is a little later in the day, which is from next financial year, April 25 onwards. It says that the definition of specified mutual funds, today it says that specified mutual fund is a fund where not more than 35% is invested in equity instruments. They are changing that to say that, the specified mutual fund means funds where more than 65% or more is invested in debt and money market instruments. So that's the change which is there going forward. So, for mutual funds, we'll need to carefully look at this, going forward as to how this tax will work. But, in the transition year, it becomes a little complicated. There are different periods to look at up to 23rd July, subsequent to 23rd July. All of that, one needs to carefully look at. And if I go on to the next slide, this is, and I think I see some questions popping up on the chat box, so that should get answered over here. Property, unlisted shares, all of that is mentioned over here. So today, there is 24 months, which is the period for a lot of these instruments. All of that continues at 24 months. I think there's one which is slump sale which is 36 months. That erroneously seems to continue at 36 months. I think, probably the FM may later on in the final version of the bill also change this to 24, but the way the law is worded, it 36 months continues for that. But property and unlisted shares, if you look at those two columns, 2 years will be the criteria going forward. The short-term capital gains will apply the applicable slab rate, but the long-term capital gains, this is where the big change comes in. That, earlier it was 20% with indexation for property. It was 20% with indexation for unlisted shares. Going forward, it will be 12.5% without indexation. So that is a big change, which is there for unlisted shares and for property. I think there is this forex adjustment which is available to non-residents, so that will continue. It's not applicable to most people, but this is a big change that indexation is not available going forward. The second row, which is on offer for sale, this is promoters who put up their shares in the as a part of the IPO process. When they put up the shares in the IPO process, there was always a question as to whether the cost of acquisition should be taken as the original cost, or there was some companies who took a view that the cost is not determinable because of the formula, and they took a view that because cost can't be determined based on the Supreme Court decision in BC Srinivasa Shetty, they said it is not possible to calculate capital gains and took a not nil capital gains position. So that again, retrospectively, there's a change in law to say that in case of offer for sale, you will calculate the indexed value as on 31st Jan 2018, and there's a mechanism given for that. But the rate of tax for long term is 12.5% going forward, and without indexation. So this is one. No indexation is one thing which has caused a lot of heartburn. And if you go on to the next slide, that there is, if we look at how the numbers should be calculated, we believe if property which is purchased as of 2001 or earlier, if that appreciates more than 8 times, then these new provisions will be beneficial. And if it appreciates less than 8%, because indexation has gone away, then this new provision will be more negative. We've put one complicated chart. We've seen one CLSA chart, and that's there on the next slide. This is a little difficult. There's too much data over here. But on the left side is tax as per the old regime. On the right side is tax as per the new regime. We've looked at different holding periods: 2 years, 5 years, 10 years, 20 years. Different holding periods. And then we've said if there is a 5% increase in the CAGR, so 5% increase in the market value of the property, then we are seeing that the new regime is always more expensive. If the house price increases 7.5% annually, again the new regime is pretty negative. If the house price increases 10%, that is where the new regime starts being beneficial in certain circumstances. So on a 10-year period, it is beneficial in this chart. And finally, if the house price increases 12.5%, then it is the new regime is always beneficial. In all the cases, the tax as per new regime is better than the tax as per old regime. So really, the capital appreciation, annual appreciation in the house value of your house, if that is more than 10, 11, 12% or more, the new regime will be beneficial. And somewhere the revenue secretary did try to make a statement that most people will fall under that category. The housing prices have been increasing at that with that kind of growth. I have not seen that personally, but that's the statement that they have put out there. So this is on capital gains. I'll go on to the, yeah, this is an interesting idea, which is that if you have had some transactions where you can keep that earlier one. This capital gains account scheme, if you deposit money for long term capital gains, you have the ability to deposit money into the capital gains account scheme and then use it for acquiring a 54 EC bond or for acquiring a residential house property, and you can get an exemption. Now, if there are transactions which you completed prior to 23rd of July, the tax rate applicable for unlisted shares of a property was 20%. But if you put in money into the capital gains account scheme and you withdraw it next year or the year after, the law says that in the year of withdrawal, that amount will be taxed as capital gains. And probably there is a view there to say that one can explore trying to take the capital gains tax rate applicable at the time of withdrawal, and that would be 12.5%. So instead of paying 20% today, can you deposit money into the capital gains account scheme and take a 12.5% rate? Definitely an idea worth exploring. I think I have a couple of more slides on capital gains. The next slide is on STT. So the government has increased the STT on options and futures. So the numbers have gone up, and 4,000 crores is the total amount that the FM is going to collect from this increase in STT. From capital gains, the changes, the total amount getting collected is about 8,000 crores. So that gives you a sense of numbers as to what is the gain that the government is achieving through some of these changes. I think the next slide is more on AIFs. There is no real change on AIFs. There is some, on the IFSC Gift City, there is a small amendment in AIFs, being also covered over there. But per se, AIFs continue, the taxation of AIF we have put out there. Category 1 and Category 2 AIF, they are generally treated as pass through for non-business income and taxed in the hands of the unit holders. whereas category 3 AIF, the AIF is, the normal tax provisions work. So, we are not getting into it. There are no changes over here, but I just said we'll put it out there for everybody to be aware of. If I go further ahead, I think buyback, this is another big change. Buyback was the way buyback tax used to work earlier was that the company doing the buyback would pay a buyback tax, and the buyback tax, including surcharge, said would be about 23.3%. And this would be based on the total buyback value less the issue price. Whatever is the issue price of the shares, that used to go as a reduction, and on the net amount, a buyback tax was paid. From 1st October, the government is now saying we are abolishing buyback tax, and instead, the buyback amount will be treated as dividends in the hands of the shareholder. And at the same time, the cost of that instrument will be treated as a capital loss for the investor. And companies are supposed to do a 10% withholding. Now, buyback is a controversial section. It has been there for some years. And, if I were to give you an example, let's say you invested at 10 rupees, and then let's say that that investment at 10 rupees was sold to another party at a price of 100 rupees, and company did a buyback, let's say, at 300 rupees. Now the way buyback tax earlier used to work was 300 minus the initial issue price of 10 on 290. The company would pay 23%. The recipient would have zero tax because it was exempt in the hands of the recipient. Now what the government is saying is that this 300 entirely will be taxed in the hands of the recipient as dividend, and the cost of 100, that will be allowed as a capital loss. So that is it's a big change. And will companies now stop doing buyback going forward? Will they shift more toward dividend? I think it's a good question. I think on the next slide we've put up some issues on buyback, which can come about. This deemed as dividend, the section on deemed dividend says that only if company has accumulated profits should something be deemed as dividend. But in buyback, there is no such mention of accumulated profits. Irrespective of accumulated profits, even in a loss-making company, it seems to suggest you can have dividend tax. And is that constitutionally valid? I think that's a question that will come up. Again, if a foreign company were to do a buyback, will that get covered? The law says it's a buyback done under Section 68 of the Companies Act. So probably a view is possible that buyback by foreign companies is not covered. Redemption of preference shares, again, it happens under Section 55 of the Companies Act, so may not be eligible. Under treaty, there's a complex treatment. So for non-residents and foreign companies, how will buyback be taxed? What is the characterization of the income? We'll need to get into all of that. To my mind, it's a issue which will need a lot of time to discuss, and the answers are not very clear. Is transfer pricing applicable to buyback provisions for non-residents? Again, a question which is very debatable and controversial. ATM benefits, to my mind, should continue to be available. If you have some income treated as dividend, then that should go into the ATM calculation. So to my mind, that's how one should do it. But again, things that are not clearly laid out in law as of now. If I go ahead to the next slide, this is angel tax, and there maybe there are three, four, yeah, there has been a lot of news articles around angel tax that you will see, where a lot of pressure from startups saying that we don't like this angel tax. Government has continuously introduced some changes on angel tax. Angel tax is a provision where when a company issues shares at a price in excess of the fair market value, then the differential was being taxed in the hands of the company at 30%. The government did give some, if you can go ahead, the government did give some exemptions for certain kinds of startups, saying that startups which are registered with DIPP, those specific startups will not suffer from angel tax. But now what they have done, if you go ahead, what they have gone and done is they've just removed angel tax. They've just completely eliminated it. So this is a positive thing for the startup industry. They can now issue shares at higher than fair market value, because as you have seen, some of the pricing in startups is does not have any logic. It probably has, it looks at very robust future, and based on that, high valuations come in, or money comes in at a price much higher than even the fair market values. So that's why I think this is a positive step. The government has said this was introduced to curb money laundering, but we do understand, startups, when they raise money, it's not really money laundering, and therefore I think government has recognized that and removed this. What happens to past litigation on this again is an open question. We'll need to see how that plays out. So that's really on angel tax. It is abolished going forward. And if we go into the next one, which is really the last slide on direct taxes, I think there are a lot of changes. The overall theme is positive, I would see. So reassessment time limits from 10 years has gone down to 5 years and 3 months. So that's a positive. Some of the limits for appeals by the income tax that has gone up. So lesser number of litigation. You know, Corporates, can they gift or not? There was an ambiguity around it, and the government has clearly made a change to say that corporates can't give gifts. So that's one loophole that they've clearly plugged out. Vivad se Vishwas scheme, there's a resolution scheme where they've said if you have old litigation which is still pending, you have the ability to go under this scheme and kind of get a waiver of interest and penalty. So it's definitely worth exploring if you have old litigation. Again, a lot of rationalization around some of the TDS, TCS provisions. So I'll not get into all of that. I'll take a pause here and hand it to Neeraj. Like we said, we'll take up questions towards the end. But yeah, over to you, Neeraj. Thank you.
Thank you so much, Pramod. And yeah, I'll cover some of the key indirect tax proposals. And as Pramod mentioned in the beginning, the idea is to probably address this particular thing more at the sector base. So apart from a lot of sectors that the Honorable Finance Minister did speak about, we just handpicked a few where we felt these are the sectors where there's a very keen focus by the government to make it like a world-class, clusters in terms of global clusters to say what can be done in some of them, and while some of them they really want to increase the foundation to a very, very, very large extent. So looking at automotive sector to begin with, automotive sector is almost contributing like a 49% to the India's manufacturing GDP. At present, in the last few years, government has introduced a lot of central government schemes in terms of production link incentive schemes, which have sort of given that red carpet welcome to all those people all those manufacturing automobile players who are ready to invest and increase the base more in lines with the electric vehicles rather than the old ICE engines. So the idea is to really top the game and be a global hub for the all of manufacturing sectors, which is why there's a lot of investment that has been pulled in by a lot of players in this industry. So the idea is that they have in this present budget kept around 6,900 odd crores of money separately for this particular sector. The idea is to give the benefits both to OEMs as well as auto component manufacturers. With Make in India as a vision, the idea is to really push the electric vehicle agenda to another level, wherein it can also address to your ESG issues as well, which is the environment, sustainability and governance issues, which is also one of the sectors which I'll take it at the end. So the whole idea here is what can be done so as to give comfort and give more support and give more ammunition to the local domestic manufacturers who are ready to take on the mantle of going into the electric sphere. So this is the whole idea where you look more from an automotive sector, few supporting benefits, a few supporting assistance is in account of giving exemptions to customs duty on very critical minerals, or extending the exemption or basic custom duty benefit to a few of these lithium ion cells and lithium ion battery and battery pack manufacturers. So the idea, as I said, is to give all the support that's required for this to be brought to a notch above. So this is more or less on the automotive sector that we look at. Of course, this 6,900 odd crores of investment, what we look at is more to do with your, FAME benefits, which is the fast adoption of manufacturing of hybrid and electric vehicles, or for that matter, the EMPS, which is Electric Mobility Promotion Schemes. So the structure is in place. Government has allocated funds, and for all we might anticipate another wave of production linked incentive schemes for certain set of OEMs as well as for component manufacturers in the automobile sector. Going forward, defense sector, defense, if you have seen that, though you might feel in terms of percentage, there's a very slight increase in terms of the budget allocation. But overall, if you see, this is one sector where India is keenly focusing on for all the geopolitical issues that we have faced in the past few years. By this, what we say, the real focus is more on the R&D piece, where almost 13,000 odd crores has probably been allocated for this in this particular sector. So there'll be a lot of companies who are, being a part in this defense sector when it comes to the manufacturing piece. So this is some sector that should be on the lookout for the next mid-year, horizon, let's say 3 to 5 years or so, where I believe that this sector will really boom from here. And they have also allocated some funds to this border road organizations as well, which brings in a little bit of flavor of infrastructure, which I'm covering in the next slide. So here, if you look, as I said, for defense as well, they have again exempted a few products, which becomes a very key component of the overall defense project. Make no mistake, even if these goods are imported into India, the major focus, if you see, will always be on Make in India only. And these are absolutely bare minimum things where there's a huge amount of value addition that's been undertaken in India. So defense sector, if you see, is one other sector which should be on the lookout for. IT, information technology sector, Pramod did speak a lot about, in terms of jobs and what is the focus that the current government has and how they really want to increase the base for the number of jobs to be brought up. Same goes with this sector. This is another sector which is constantly booming. We can't stay far away from this Gen AI thing, and India has allocated almost 550 crores for India AI mission, artificial intelligence. So any companies or anything that goes, or any company for the matter, which uses AI as an enabler for it to do better, is something that we can keep an eye on. And this is something that a lot of digitization in terms of a lot of services that the government intends to take care of will be on a high now. And a constant effort has also been put so that, we increase our footprint in the global landscape. So this is one of the other key areas which, we'll be focusing on as we proceed. Infrastructure, we all have heard around 11.11 lakh crore of this has been set up for infrastructure. The idea is to probably have 100 industrial corridors across 100 cities, rather industrial corridors across 100 cities, where it wants to make like a plug and play parks for it, which means infrastructure is something that will again be on the rise, where you all need to have the world-class state-of-the-art facilities available in all such places, where it's more like a absolutely top-class incubation centers. You come and you have all set up already there. If you see in and around, especially for the global capability centers also, you would see that a lot of foreign players are wanting to set up their center of excellences back in India because of the the high quality skilled labor available and the facilities also which are available. So all of this goes hand in hand when it comes to infrastructure. Of course, roads, bridges, and these are something that's always been on a keen focus on, and which is why this particular sector is something we believe will again always stay in the limelight for at least a few years to come. Power and utilities sector goes without saying that, as you all are aware, that in 2015-17, India was a part of this Paris Convention, which has agreed to, the 17 Sustainable Development Goals, wherein one of those key factors was that we would want to be a carbon net zero by 2070, and which for which there's a lot of efforts been taken by the government even as we speak. One such is that as per SEBI has made it mandatory that the top 1,000 companies, basis the market cap, would be required to mandatorily start reporting on efforts taken on ESG space. The top 250 has already been started reporting, and it will probably be introduced in phased manner. But the number of activities that's happening across the globe, for example, if you see, European Union has already introduced something which is called as a Carbon Border Adjustment Mechanism, which is CBAM. What it means is, if an Indian manufacturer is exporting any goods to Europe, he has to start reporting what is a carbon emission that has taken place for this entire manufacturing activity that is done in India. Now, this mandate that's happening from EU has been slowly and steadily been adopted by a lot of other developed countries, including US, Canada, UK, Australia. Apart from this major OEMs in India are also started speaking to their vendors to say, what effort are you taking to curb the carbon emission? Now, by this, what's happening is there's a lot of discussions happening in the boardrooms where a major focus is going to happen on this ESG space, also, which is emanating out of this sector to say, in terms of solar and innovative technologies and a green tomorrow, what is it that probably effort have been taken by each of those companies? Government has also started working on. There's a lot of national action committees set in place. They have introduced provisions in terms of carbon credits and green credits, and they want to incentivize this to the private players, though even not mandated by any regulations, but are taking efforts to probably go ahead and let's say plant trees or take care of water wastages, and how do we incentivize them? From what we understand, that might be a plan as we proceed, is somewhere this could also, this carbon credits and green credits is something that will probably also get registered just like your stock or your shares rather, and which will be absolutely bought and sold in the open market, because all of this will definitely have an implication on the carbon cost that you would eventually end up paying while you export to other countries. And for all you know, India would also introduce similar provisions. So in that background also, in terms of prioritizing the energy efficiency, government has also introduced this particular PM Surya Ghar Muft Bijli Yojana, which means every house can probably have rooftops solar, so that they start generating this power and then use it for their own consumption. And which means this sector, specifically solar and renewable sector, is something that will always be of critical importance as we proceed and in times to come. Lastly, very generically on what is there in this particular budget when it comes to indirect taxes. I'll just try and put it across in brief. There's a lot of benevolent provisions that's been brought in. They have introduced some bit of an amnesty scheme for a period up to 31st March 20, wherein if you have paid the taxes, the interest and penalty can be waived. This is all subject to conditions, and I don't want to really go deeper into those provisions though. So that's one welcome change that has come. Second is there were initial lot of challenges that we have seen where you were required to claim the input tax credit in a specific timelines, but that you could claim only at a later point in time, and that was being litigated. Now they have said for the period from July 17 till March 21, if the credit has been claimed till 30th November 21, it will be continued to allow, and they will not probably call it back, which has again gone ahead and reduced the implications of litigations as well. They have also merged particular provisions in terms of issuing notices to bring some uniformity there, which is the 74A, if you see the second line here, which has been introduced. A lot of custom rate rationalization, as Pramod did mention in the beginning, to say, because if you see there's some of these notifications under custom, which is still there right from 1960s and 70s, which probably has been phased out. Either they are sunset clauses or they are extended or they are rescinded. So either which way, the whole idea here is to see how we can again give a great amount of comfort to the domestic market, and also at the same time ensure that just because there's a lot of dumping happening from outside of India, it doesn't really spoil the market out here. One other small change is a lot of time we have seen department authorities issuing summons to the directors and CEOs of the companies to come and present simple documents like balance sheets and all that. So right now they said even for summons, you can send an authorized person, need not appear in person. And the only point what they've said is such person should be in a position to should be in a position to record a statement. So it could be a tax head or a person who is looking after accounts for you, who can actually go. You just need to issue an authorization letter, basis which he could go and record the statement, make the submission. That director and the CEO really need not have to travel. I think this was more or less what I thought I would cover more on the indirect tax piece. Maybe I can, open up this for questions, and back to you, Pushkar.
Thank you, Pramod and Neeraj. It was really great to have your insights. Before we start with the questions from the participants, so basically, one question which came into my mind. So, Neeraj, probably you might be the right person. So, we said that manufacturing in India and mobile phones and all we were manufacturing here, and suddenly when the customs duty is now reduced probably, so is it something which is probably uh, against what we were trying to do, and similar to that the gold import duty as well. So there was a lot of so under our imports this thing gold was also one of the major this thing. So what is your view on that?
See, I think on gold, what has happened, we have read in some of this, this to say that one of the snippets was gold is probably contributing around 8% in terms of the whole contribution to the economy. There are almost 50 lakh workers who are engaged for anything that has to got to do with gold. So the way that government looked at is that by reducing the probable reason, I believe we'll have to really need to know why that has happened. But looks like the reason for reduction on customs duty on gold would have more to do with trying to see whether more people can get engaged in terms of securing the jobs or going increasing the consumption in one sense. And if we see gold is something that a lot of people really don't mind investing, and which is why by reduction of that cost, it might really help the industry to again sort of ensure that more and more people are getting involved in this particular sector.
And is it similar to that for mobiles also? Because
so mobiles also, what is happening, as we all are aware that the iPhone manufacturing is something that's sort of again that's set up here in India as well. And what we'll have to really see that specifically the mobile and mobile phones custom duty rationalization, if you see in one sense, that will also be to say either there are other sectors, other players who would want to be brought in India, and or these are very specific components which becomes far more an important component to be used in the manufacturing of mobiles as well. So these are some of the factors that's normally considered whenever there's a rationalization on account of the customs duty.
okay, so we have few questions which probably Pramod has right to answer.
Maybe,
So
Pushkar, I'll take one question specifically which has come up, which is on properties which were acquired prior to 2001.
Correct.
A lot of news articles which says that for the old properties indexation continues, and for new properties it is no longer there. So that's not the right way to look at it. The way what used to happen earlier. See, indexation as a concept, that was introduced in the year 1992. I think in 87 you had some deduction, and the way we know indexation as is today, it is there in the book. It started in 92 with 1st April 1981 being the base year. The base year was reset to 1st April 2001. So what would happen is any property purchased prior to April 2001, you would be able to substitute the fair market value as on 1st April 2001 and then apply indexation on that, when you do a sale today. So example, let's say that you buy a property in the year 1990. The cost as on 90 when you purchased it, or the fair market value as of 1st April 2001, whichever one you want, you can substitute. And normally the 1st April 2001 value would be higher. So you would substitute that. That's already
Correct.
some indexation that you're getting up to April 2001.
Correct.
And then
Correct.
if you sell it today, normally you would have said from 2001 till today, the index is about 360 today. So 3.6 times from 2001 till today is what you would have got as indexation. What has gone away is the indexation post 2001. So you still get to substitute the value as on 1st of April 2001. I think that still continues. So to that extent, you can say indexation continues. But it is not right to say that for old properties you will get indexation till today. It's only the
Correct.
substitution of April 2001 value that continues.
So
And
like a
I think a lot of
grandfathering.
newspapers seem to suggest otherwise. So, that's one clarification. I think this
Correct.
date of agreement versus date of possession, that's a very complicated question and very fact specific. Is the property ready? It's not ready. If it is not ready, then I would go by possession date. If the property is already ready and it's a second sale, then agreement date becomes relevant. In Maharashtra, you have this concept of agreement to sell followed by a registration within 3 months. So all of
Correct.
that probably, I would say it's very fact specific and complicated, but it does throw up some opportunities if you have just done an agreement to sell before 23rd of July, and now can you take a position that I'm completing the registration after 23rd of July, in the next month or so, can I apply the new date? I think it's definitely worth exploring, but yes, there will be litigation around.
Okay.
Any other questions? Yeah.
So for NRI sale of property, that is one question wherein for NRI sale of property should be invested in which way? Is FDI in INR to be looked at? Best to ask. Okay, you have
So
already answered. So yeah.
no. So I'm saying, where to invest the money, I'll leave it to you all
Yeah,
to decide.
correct.
Wealth advisors are best placed to advise
Correct.
where to invest. I'm not really, I don't have any competence on that. But yeah, if you, the rollover benefit, as we call it, if you invest in 54 EC bonds or you invest in another property, you can get exemption. Those rollover benefits continue. Nothing has changed over there. So, that rollover benefit is available to NRIs as well. It is just that they are available for specific instances. There are some specific 54 EC bonds. Similarly, reinvestment of into another house property up to a 10 crore value, that exemption still continues.
Yeah. So exemptions basically are continuing.
Yes.
Uh, One of the participants has asked, you have probably already tried an answer, for a retired person with rent income and SWP, which is tax reserve is recommended. Okay, so again, it is a person specific thing that we will have to probably
That is
take it up separately. Uh, You covered the buyback thing very well, so even that is. Uh, We have also covered, so for example, in the debt mutual funds now, it will be basically the 12.5% which will be applicable. That is probably one of the common questions that would come to most of the investors.
This lot of mutual funds will go into the 12.5% category, but
12.5%.
there is one category which is excluded. So if you have more than 65% invested in debt or money market instruments, that kind of mutual fund, there they are saying all the gains will be treated as short-term capital gains.
Correct. And basically, see, all this, provisions are proposed, right? So we have to go ahead with the view that this is what it is, unless, if there are changes, if, things don't get passed in the finance bill. So, but we have to treat it as if we are, from 23rd July, whatever happens, this new things will be applicable.
So yeah, you are kind of put on notice today. There's a section 294 in the act which says that, in the interim, one can take some steps based on either of the provisions. But, once the law gets passed, typically
Correct.
within 45 days, the bill will become an act. And, once it becomes an act, it will be applicable from 23rd of July. So, if you have advance tax deposits coming up, or, you have TDS to be done, then, these new numbers should ideally be kept in mind when doing that. New changes, you should assume these changes will happen. Will
And then take
government
the
does
decision.
have, as a part of passing these bills, sometimes we do see some further changes happening.
Okay.
But one has to keep a close watch on it. But right now, planning should be done on the basis that what the finance minister has proposed in the finance bill, that will become law.
Okay. And so we spoke about this sectors, so like defense, IT, manufacturing, and auto from the manufacturing thing only. So we still, I mean, what I could understand is there are some positives for these sectors. Any specific sector which is actually got affected negatively in in any scenario?
See, I think they have not sort of. It'll actually depend on how you look at it. I'll give an example. Let's say an auto sector.
Correct.
Now, as we say that the focus is purely going to be on the EV, right? But if there's any player who is still sticking to his age-old ICE model, where it's, let's say, your and our typical petrol and diesel engines,
Correct.
somewhere if you see that sector might get impacted if you look at one sense. The government idea from where I look at it is not to pull down any specific sector. What it is doing, it is only trying to think absolutely futuristically. So they are looking. We are absolutely talking of EVs as a next step. And normal course whenever this PLI got introduced was an ideal way was to go from an IC engine to an hybrid and hybrid to an EV, and rather than
Correct.
taking one step at a time. But we really
Correct.
jumped the gun. Of course, there were a lot of heat to the from a lot of sectors to say that you are asking us to invest again and then take it to the next level, and all of that happened. But eventually, you fall in place, right? So if you look at this right now, textile PLI, is also been introduced, which is a production and incentive scheme. Though very little has been or nothing has been spoken very specifically on this in the budget, but the government's keen focus is that we will have to create some 8-10 particular sectors which should be global players. I mean, the idea is to make them, maybe we'll need only 5 great players in that each sector. If I say textile, if I say automobile, if I say solar, I need only 4 or 5 players to be top-notch players, but who are global players. I mean, really, they can cater the what do you call the global demand and so on and so forth. What we'll have to also understand is if I choose one OEM, I'll at least have 50 other component manufacturers will also grow with them. Similarly, which happens with all other sectors. So as such, if you see, the focus on sector is very much there, and this has more so become ever since this PLI scheme has come into play, and it has really paid dividends to some extent. If you really ask me, only one odd sector, like for example, let's say the electronic sector. Now they have come with a lot of central government schemes, state government schemes. Let me tell you this. Let's say if you are actually working on a specific sector, let's say an electronic sector, if that product is something that falls within this policy in terms of the product for which the benefit is given, and if your fact pattern is very specific or which caters to at least 7 on 10 points, if you are investing 100 crores in 8 to 10 years period, for all you know, you might get 120 to 130% of that investment back to you. Now, when you look at it, how is this possible? So there is central policy, there is state policy. Now, which state are you going and investing, and what is the state government doing about it? So, one of the questions that I see, whether which I've read here, does a policy on until reduce the heat on mutual fund investment? See, I believe I mean, we all know industry will never want to go ahead and make an investment because they want to get something back from the government. The idea is that you believe in that particular, manufacturing or service orientation. And with that, when you get these add-ons, it really adds a flavor. So to answer this question, I believe there's no some specific sector which really will go down. The only idea is to be think futuristically. And let's talk of allied services, right? Let's say if you're looking at auto sector, if the number of EVs are going to go up, we all are going to go ahead and buy EVs. We need bank financial support as well. So that means banking and financial or lending institutions will always come into play. So which again means that particular sector is going to go up as well. So we have to look at holistically, and that's where maybe like Pramod mentioned a few moments back, players like you will really play a key role to really understand what can be those allied this where you can invest well and you can grow well.
Correct. One more question related to this, Neeraj. So basically, we all of us have heard about China plus one and Europe plus one. So there are countries who are competing with us, right? So is this budget pro that, wherein we can actually enable our own companies to grab the opportunity which is there? Maybe it's specialty chemicals, or all the sectors which you already mentioned.
Absolutely. So I think, and I think Pramod, you can also add on the rate rationalization more from a foreign company standpoint also. See, somewhere I believe, ours is like this, subject to certain conditions. A manufacturing company, the direct tax rate is one of the lowest in the globe, which is 15%, effectively 17%, if you see. And maybe Pramod is the right expert to speak on that. But what's happening is China plus one is definitely a game that has taken up a notch level. When we look at compete, we might have, in terms of infrastructure, we might have a lot of other countries who have really up the ladder. But when it comes more to do with the cost and also the skill set that's available, I mean, we are really up in our game, right? I mean, we really scored good amount of points there, and the government support as well in terms of incentivizing such players. One. Second, let's say if you take a specific state, because every state, it's a federal economy, right? Every state is really fighting tooth and nail to get it. So if you go to somebody like, this is not a political discussion, but I'm saying my experiences, I can tell you. If you go to Gujarat MIDC and you want to tell them that this is the investment that you want to do, you really get a red carpet welcome. I'm not commenting on other states, but if somebody is asking, okay, do I get the money in my account? What state will, probably top the list? We would say Maharashtra today. Because in Maharashtra, the schemes have happened since almost like mid 60s and 70s. PLIs, okay, these were called package scheme incentive schemes, but over a period of time, Maharashtra has been matured enough. Again, as I said, this is not like trying to pick up a particular state here. What my only point of here is, China plus one is something that we have really focused on, built on. Like when we speak to our clients in the industry, they are really keen. So their parent company could be based out in Germany or US or wherever, or Europe. And then when they come to us and when we speak about this, they're really keen on looking at India, because if that sector fits in well, you are able to get the lot back from the government as well, which those some other countries, like I have heard about Philippines and Vietnam, they are also following this, but there the challenge is more to do with the skill set. And that's where, at least I believe for the next decade or so, maybe we still have that, we still are up there. And probably
And
may add
maybe, Neeraj, if I can just add over here, you mentioned that 17% rate, that's a rate which was available for new manufacturing companies set up after 1st October 2018 and starting manufacturing before 31st March 24. So, that was a very great initiative, which was introduced earlier. There were hopes and expectations that some continuation of that may happen, that 17% rate is available to companies set up already and who have started manufacturing before March 24. So, there was a hope from the industry that even, with all these PLI schemes and all of that going on, even new companies will get that benefit. That has not happened. You still have 25% rate available to companies, which is a good rate. So per se, the government has not gone and said, they have more, the thrust is more on employment and thrust is more on making procedural simplicity, ease of doing business. They have not gone and changed the rates. For foreign companies, they have brought down the rate from 40% to 35%. They have removed equalization levy. So they have done some things for foreign companies, but foreign companies typically don't directly come in and work in India. They invest through subsidiaries. So it is the Indian company tax rate of 25% that applies. If a foreign company works as a branch or as a permanent establishment, then that 35% rate comes into play. And on China also, very interesting that as a part of the press conference, the FM was asked that the economic survey actually recommends to the government that there is, for investment from China or some of the other neighboring states, there is something called as a PN3 approval. You need a special approval to permit investment to come into India. That's the rule that is currently in play. So economic survey suggests to the government that you should simplify this, liberalize this, and encourage investments from China. And the FM said, I'm not getting into that right now. There is a process in place. We'll follow that process for now. We in fact want to prop up India as an alternative to China. And we have put up a tax regime which promotes that. So we'll we'll see how that happens. Another interesting point that I missed mentioning in the different allocations in the budget for the Pune Metro project, 814 crores is set aside for, the Pune Metro project. The
Oh,
Pune
okay.
had asked for 1500 crores, but, we've got at least 800 crores. So I thought I'll mention that as well. I think on the heat on mutual fund investments, what the government is saying is that, choice of instrument should not be driven by tax. They're
Correct.
trying to say that you may have portfolio diversification, you may have different kinds of instruments, but there was this whole mess around gold being taxed in a particular fashion, FDs being taxed in a different fashion, real estate
Correct.
different, mutual funds different, shares
Yeah.
different. They are trying to somewhere simplify all of that and said that let tax be simple, and the choice of the instrument should be based on portfolio diversification, the risk appetite.
True.
Those criteria should have a better and bigger role to
Yeah,
play.
that is what we basically take into
The
account.
arbitrage is gone in that
Correct.
sense. They're trying to eliminate it as far as
Simplify things. That's correct. Thank you, Pramod, and thank you, Neeraj. I think let's see if there are any questions. Otherwise, we'll end the call. But overall, I think what I feel is what I can understand. It's a positive budget for the economy, and things are looking good here on forward basis, right?
Yeah, absolutely.
overall big positive. I think fiscal discipline being maintained, the kind of growth that India is a bright spot in the world economy. So
Correct.
overall, I would say yes, it's definitely a big positive.
So we'll end this session on this good note, and let's make the most of this positives what have come up from the budget. Thank you, everybody. Thank you, Pramod and Neeraj, for taking
Thank
out
you.
time.
Thank you. Have a
Thank
good
you all.
Thank
day.
you, all
Thank
the
you for having
participants.
us. Thank you very
Thank
much.
you. Yeah, thanks.